Welcome to this debrief. We're going to look at the December 25 PM ACCA mock. This video is the Section A questions. There'll be a separate videos for the other sections. But before I start, just a little reminder of our timing for the exam. So looking at Section A first, there's 15 questions in Section A, each worth 2 marks, so 30 marks. We generally work on the principle of 1.8 minutes per mark. So that's 54 minutes. And your approach for Section A, I would certainly recommend, if you come up against a question that looks like it's going to be a very long, complex calculation, or one that's just a difficult question for you, just use the flag system. If it's multiple choice, take a guess and then move on. And if when you get to the end of all 15 Section A questions, you've still got some time spare, you can jump back to the flagged ones and then spend a bit more time on those. But you should definitely focus on getting that low-hanging fruit first. Then on to Section B, also 30 marks, so also 54 minutes, but the 3 case studies, so roughly 18 minutes for each of the 3 case studies. I would treat each case study as one, so I would spend 18 minutes on that set of 5 questions. Some of them will be a bit easier, some will be a bit harder. Again, if you can identify the easier, faster marks, go for those first. And then if you've still got time left in your 18 minutes, then address the other ones, then move on to another case study. And finally, Section C, 40 marks. There's 2 questions, so 36 minutes for each. Time management is a really important strategy you need to develop when you're doing PM. Some students spend a lot more time on some sections than others, and they end up missing out on some of the easier marks that they could have otherwise got. However, despite what I said, I will go through the questions in order. Otherwise, it's a bit difficult for you to jump back and forwards to find the answers, so I will address them in the order they come. What I won't do is sit and read the question out. What I'd much rather you do, hopefully you've had a go at doing the exam, you definitely should do the mock before you look at the debrief. That's when you're going to get most value from it. But I'll leave the question on the screen. You can pause, read through it, and then unpause as I go through it. So I'll land on the screen and I'll just pause for a second or two to give you a chance to press the pause on the video. So we've got a negative multiple choice, which of the following does not justify switching, which means one approach is to find all the ones that do justify switching and which is the odd one out. The top one, they'll have better quality data, probably more real-time data that would support a move to ABC. If overhead cost is higher, that tends to also lend itself to an ABC approach. A highly machine-intensive, multiple-step and tailored product type, once again, that's much more of an ABC requirement. That only leaves this bottom one. If there's less competition, then there's less justification. Absorption costing and activity-based costing don't change our costs, they just change the way they're apportioned. Although there are options to focus on the cost drivers in ABC. Certainly that's the better answer there. So let's look at these. The target cost gap reflects whether actual performance achieved is better or worse than budgeted. That's a variance, that's false. Techniques like value engineering, functional analysis and reverse engineering can be used to narrow down the target cost gap. True, those are all methods that can be used. Be careful when you've got a list like that. Make sure you can say true for each of them, because 2 could be true and 1 false, which would make the whole thing false. In this case, they are all true. An upgrade in current manufacturing technology is likely to reduce the target cost gap. That's true. They'll be likely to achieve more efficiencies, maybe faster production at lower cost. So that one's true. And finally, revising the target price and the target profit margin to reduce target cost gap aligns with the primary purpose of introducing target costing. Both of those are false. We do not revise the target price and the target profit margin when we're looking at target costs. On to question 3, what is the throughput accounting ratio closest to? If you pause now so you can read through this. I've opened up my scratch pad here. We're not given the throughput formula. Formula sheet is down here. You should hopefully be quite aware of what you are and aren't given, but throughput isn't one of the ones that we're given. The throughput accounting ratio is the return per factory hour divided by the cost per factory hour. I do not recommend writing these things out. This is more for the tuition element here. In reality, this may be one of those questions you take a guess, flag, using the flag up here, and then come back to review later. Hopefully you'll have remembered that the return per factory hour is based on the bottleneck resource. We've got two processes. One is the cut-in and the second is the sew-in. Let's take a look at cut-in. Cut-in is a fully automated machine and they've got two of those. What we're just working out now is how many units they can do for cut-in and sew-in and see which is the bottleneck. So they've got two machines working 10 hours a day for 30 a month, which means they've got 600 hours available. The cut-in time takes 0.1 hours, which means they can produce 6,000 units, but the output is 4,800, so that's not a bottleneck, which means sewing time must be. Now we have a choice, do we actually work out whether sewing time is? One of them has to be. If I work out sewing time and it's not, then I've probably made a mistake. Or I could just assume sewing time is and carry on. This will probably come down to confidence. Your confidence in your process and your mathematics. I'll do it properly, do the full thing. And we've got 4 sewing machines handled by 4 labourers. So this is 4 times 30 times 10, 1,200 hours, and it takes 0.25. So sewing is the bottleneck and it coincides with the monthly output there. So we're going to first work out this part, the numerator of the throughput to counting ratio. So we find the selling price and the direct materials, only materials, subtract that from the selling price, that gives us our throughput. And then we divide that by the time spent on the bottleneck resource, which is 0.25. So selling is 38, direct materials. What we need to do is take our contribution to sales ratio of 40%. That gives us the contribution of the selling price. So if we find the 60%, that's our costs. And then the percentage of total variable cost, that's materials, is 45%. So we take the 38, multiply by 60%, that's the bit that doesn't form contribution, multiply by 45%, which is the amount that is direct materials. So I have 38 minus 10.26, divided by 0.25 is 110.96. So that's this bit here. Now we need the cost per factory hour. These are all the other costs. So it's similar to what we've done here for variable, except it's now the 55%. We also need to bring into account our fixed costs. And the way to do that is, what's the total of the variable costs is the 1254 times 4,800 units. And then we add to that the fixed cost of 30,000. So that's 9192. And then we need to divide that by the number of available hours, which we already calculated up here as 1,200. You see I'm trying to keep the information on my calculator when I can. So we've got both the parts we need now. We've got our return per factory hour of 110.96, the cost per factory hour 75.16. So divide 75.16 into 110.96 and get 1.476, which is the top one. I said at the beginning of the question, this is probably one to flag and then come back. Obviously there's the length of time required, but also every step we do, there's a chance of an error. So definitely use the flag for these more complex ones. But if you did this one and got it correct, well done. So we need to match the correct performance indicator to each of the VFM performance categories. And if you pause now to read the rest of the question. So one of these will be an economy measure, one an efficiency and one an effectiveness. Economy is about getting the required resources in terms of quality and amount for the lowest cost. Effectiveness is about the output, how well are they achieving their goals, which is probably captured in there, providing a safe and secure living environment. And then efficiency is how we turn those resources into those outputs. Efficiency normally is measured in a something per something. We've got two that have per in the name. They're not both going to be efficiency, so we're going to have to do a little bit more digging there. But crime rate is not about what we're putting into the system. It's also not about turning inputs into outputs. It is about the output, how effective they are. So now we need to decipher these other two. Well, economy is about a financial input, and only this one has financial in it, cost per crime. Number of residents per police officer is an efficiency measure. If you have more residents per police officer, that's more efficient. Just as a side, a teaching note, what's likely to happen is if you have more residents per police officer, you might actually have a worse effectiveness. The crime rate may be higher, so although it's better on efficiency, it may be less good on effectiveness. And these three often interact in that sort of way. Which of the following EMA techniques does not consider financial costs resulting from business activities? Well, flow cost accounting looks at materials flows, including the quantities, but also the costs and their value. Input-output analysis. This is the correct answer because this one looks at the amount of material we put into a system, what we get out, and the difference, the bit that's missing, needs to be accounted for. Life cycle costing looks at the cost over the entire life, so that's obviously not true. And activity-based costing, even if it's environmental, does consider financials. Question 6. What is the profit maximizing selling price per unit for a period to the nearest whole dollar? Again, this may be one that I would be flagging and coming back to. I know I've spoken about this on previous debriefs, but you may not have seen them. When I use the scratch pad, I use it in reverse order. So I have my more recent question higher up. The reason being, when I open it, it automatically defaults to the top. If I've got a long chain, I have to sit scrolling, wasting time. I'd much rather just be where I want it. Hopefully it will save you a couple of minutes in the exam, which could be a mark. So I've opened up the formula sheet. We've got the demand curve formula here, but I imagine some students have looked at this and looked at this top line and been thrown because we've got 600q minus 2.5q squared. And so there's a bit of a mathematical thing you need to do in order to, if you like, unlock this to take this one through. And it tells us the total revenue equals this 600q minus 2.5q squared. But total revenue also equals, it doesn't tell us this, the selling price per unit multiplied by sales volume. And what you see here, we've got Q is common to all three. So therefore we can take Q out completely from two of the terms, leaving it in the one that's squared, effectively dividing by Q across all three terms, ending up with P equals 600 minus 2.5Q, and hopefully you then see we've now replicated this top line. So we've found our two constants, A is 600 and B is 2.5. The profit maximizing price occurs when marginal revenue equals marginal cost. So marginal cost equals the cost of selling one more unit, which is normally the variable cost per unit, and we're told it's direct materials of 116, conversion costs per unit of 134, so that's 250, which when profit is maximized equals marginal revenue. Then we plug in that to this bottom formula here. We found the constants A and B above, so 250 equals A, which was 600, minus 2 lots of 2.5Q. Remember, this is giving us the value of Q, which is sales volume, at the optimum selling price. So it is the optimum number of units to sell. So I will rearrange that as I go. So 5Q equals 600 minus 250. Q is 350 over 5, which equals 70. So that means 70 units is the optimum number of units to sell. Now we need to go back up and plug that into here because we need to find the optimum price. So price equals 600 minus 2.5 times 70. So our answer is 425. To the nearest dollar, we've got no decimals, so we don't need to worry about that. Question 7, indicate by clicking on the relevant boxes below whether each of the following conditions will justify the use of incremental budgeting as appropriate or inappropriate. So pause the video to read the other part. So the first one, cost control, is a major issue. That's an inappropriate application of incremental budgeting. Because incremental budgeting relies on what's happened before, adjusted by inflation, for example. If it isn't correct before, then it's not an appropriate methodology. This one is appropriate. If most of the costs are contractual, then there's little you can do about them. So there's no point investing a lot of time, energy and money in having a complex budgeting process. A simple one like incremental will be appropriate. And this one's inappropriate. New competitors come into the market. That means information from the past is no longer going to be reliable going forwards in terms of setting that budget. So incremental approach isn't suitable. Question 8, using activity-based costing, what is the total cost per unit of headwear? Why? Once again, my gut feeling without having looked through this is this could be one to flag because ABC calculations tend to be a little bit lengthy. So we're going to have to work out how much each production run should be allocated of the 75,000, how much each machine hour has to be allocated of the 110,000, and how much a single batch is allocated from product handling. Okay, so each production run, there are 75,000 in costs over 200 runs is 375. I just did a little typo there, it's 110. I wouldn't be writing these out in the exam, I would just be doing the calculations. So that's 4.4 per machine run. And then finally the 95,000 spend on product handling per batch is 250. I can do my calculations for product Y over here. So how many setups does this have? So there's 2,500 units ordered with 50 in a batch and 2 batches per production run. So the 2,500 batches divided by 50 times 2 is 25. Now multiplied by the 375, which is the cost of 1, that gives me 9,375. Okay, on to machine handling. Well, there are 2,500 units and they require 0.25 hours each. And each hour we've calculated is going to be allocated 440. So that's 2,750. And then finally, product handling based on number of batches. So that's the 2,500 divided by 50 this time. So 50 batches at 250 each is 12,500. If we add those three together, we'll get 24,625. And then we need to divide by the number of units, which is 2,500. Gives us 985. As you can see, that is one of our answers, but we've also got direct cost per unit, gives us 2185. So that's a distractor, obviously, put in for the specific reason that people might forget the direct costs. So remember, all of this is allocating the overheads. Which of the following statements describes the theory of constraints? The marginal return generated by an additional resource will start decreasing at a certain level of production. That's not the theory of constraints. That comes into that optimal pricing, similar to a question we looked at a couple of steps back. In every production process, there is at least one factor that limits its performance and as a result its output. That's a bottleneck and that's part of theory of constraints, so that's true. In a labour-intensive process, improvements in efficiency will eventually cease when staff reach their physical limits. That's related to the learning curve or the learning effect. Direct labour costs should be treated as fixed costs in the short term because these costs are unavoidable in that time frame. That's one of the assumptions in throughput accounting and so therefore not theory of constraints. But this is quite a clever question because if you had a bit of knowledge on all of these things, they might all sort of ring a bell and you might think, oh, is it that one? Is it that one? So it's quite a clever question that makes students perhaps question their own understanding. Okay, if only P1 were to be made, how many units to the nearest unit would need to be made in order to achieve a profit of 50,000 each year? So once again, if you pause so you can read through the rest of it. My expectation in this question is the maths behind it is probably not too difficult, but I think there are a few pitfalls that we could accidentally fall into. So we've got the information for P1 and P2, and one mistake is maybe to we're only looking at P1 and then completely ignore P2. But that's the first mistake because there's fixed overheads and it tells us that fixed overheads in P1's case are an apportionment only. In P2 has specific overheads totaling 5,000, i.e. they're related to P2. If P2 is not made, then those 5,000 overheads won't be incurred, but there's probably other overheads in there which would be incurred. So I think that's where the mistake could probably be made, and I suspect two of the distractors. One is probably if you ignore P2 completely, and the other is if you assume this 5,000 is incurred anyway. So to make a desired profit, we add our profit to our break-even revenue and divide by the contribution per unit. So our break-even revenue is how much we need to cover our fixed costs. The profit is the 50,000 we need to achieve here. And if we find our contribution per unit, divide into that, we end up with a number of units, which is what it asks us, in order to make that profit. So the 50,000 we know is the profit. We need the break-even revenue, which we don't know yet, and the contribution per unit we don't know yet. Let's work out the contribution per unit first. It sells for 12. We've got 450 materials, 2 for labour, 0.7 for variable, and we don't include fixed in this, so that gives 4.8. The more efficient way is to take the profit per unit and add back the fixed overhead. Now we need to find the break-even revenue, and that equals the fixed costs. So the fixed costs are, the fixed overhead for P1 is 150, and that was based on 10,000 units. And it was $1 for P2, which was based on 15,000 units. But that includes this 5,000 specific overheads, which now will not be incurred if we didn't make P2. So that's 15,000 plus 15,000 minus the 5,000 is 25,000. So now we can do our final calculation, add those two together is 75,000, over 4.8 is 15,625, and that's one of our answers here. Question 11, identify by clicking on the relevant box in the table below whether each of the statements regarding the response of both divisions on the transfer price quoted is true or false. I suspect that should say responses. And again, if you pause so you can read through the question. Okay, a lot of information to digest there. And again, this is probably one to flag and come back to, just to make sure you're using your time as efficiently as you can. So firstly, will division M be negatively impacted by transferring additional output of product M1 to division C at this quoted transfer price of 183? Well, its minimum transfer price equals its marginal cost plus its opportunity cost. And there's an opportunity cost because it always operates at full capacity. So if it's going to do this transfer to division C, it therefore cannot sell those products to the external market. And the marginal cost with 125 is the total cost, 60% variable, and the opportunity cost, it sells externally for 180. And again, the total cost 125, but only 60 is variable. So 125 times 0.6 is 75, and 180 minus, that's 105, so 180. So the minimum transfer price that it would accept is 180. 183 is what's been quoted. So would it be negatively impacted? No, because the quote is higher than their minimum. Will division C agree the transfer price and purchase at 183? Well, division C can either purchase for 183 from M or 186 externally. However, if it purchases from M, it will incur transportation of 9 per unit. So once it adds the 9 on, it's 192, which is more than it's selling it for. So it's not going to be happy. So question 12, what are the forecast sales units for the second quarter of year 3? Sales is given by this formula here, where X is the quarter number where the first quarter of year 1 is 10. And then they also apply the following seasonal variation. So a couple of stages we need to do. First, we need to find the value of X. So be very careful. X denotes the quarter number where the first quarter of year 1 is 10. And we're in the second quarter of year 3. So year 1 would have had quarters 10, 11, 12, 13. Year 2 would have had 14, 15, 16, 17. And year 3, 18, 19. So X equals 19. So 105, 500 plus 8,000 lots of 19 gives us 257, 500. So now we need to do the seasonal variation. We are in the second quarter, so 110% or 1.1 gives us 283, 250. Okay, question 13. What's the adverse sales mix profit variance? I like this approach for mix and yield variances. So for a mix, I'm comparing the actual quantity at the actual ratio to the actual quantity at the standard ratio. Some people use mix instead of ratio. And I've got my little table here for X, Y, and T being total. So then I just pull into here the figures that I know first. So actuals is often a simpler one to do. So we're doing 1100 and 700 for Y. So if I total those together, I've got 1800. Now this one will also be 1800 when we're looking at a mix ratio. Those two are always the same. But what we now need to do is take that 1800 units and reallocate them to X and Y based on what would have happened had we adhered to the budget, which means for every 600 Ys that were sold, 1200 X's should have been sold. And that's a 2-to-1 ratio because 600 is half of 1200. So how do we work out the AQSR for X? Well, it's 2/3 because it's 2 divided by 3 using the ratio multiplied by the 1800 gives us 1200, which means this has to be 600 because we know it adds up to 1800, but just to do the maths, it's 1 divided by 3 multiplied by that 1800 is 600. And then we find the difference. Got 1100 is actuals compared to 1200, so that's minus 100. When we're doing mixed ratios, they have to balance out, so that has to be a positive 100 and the total has to be 0. And for the profit, we use the budgeted profit, not the actual profit. So we've got our answer as 500. It told us it was adverse, but we could have seen that anyway. Because we're talking about sales, the minus 900 was adverse because they sold actually less than they were expecting to sell for X, and they sold more Ys, but because the profit was higher for X than it was for Y, that leads to the adverse variance. Question 14, select whether each of the following statements regarding performance management in NFP organizations is or are correct. Objectives can often be non-financial or non-quantifiable, which makes it more difficult to assess whether they've been achieved is correct. That's one of the challenges when you're dealing with NFP performance management. Because these organizations have multiple objectives, it can be difficult to identify which ones are most important to measure. Again, that's one of the characteristics of NFPs. Unlike commercial organizations, NFPs need to focus primarily on the interests of internal stakeholders when managing performance. That's not true. External stakeholders are also important, and sometimes it's worth thinking of an example. So a hospital, for example, or a college, or a local authority, any of those would be non-profit organizations, and they've got external stakeholders. Their interests are also aimed to be met by the organization. And then finally in section A, which of the following forms of data visualization facilitates is least, strange word in here, which of the following forms of data visualization facilitates is least likely to be used for time series analysis? I don't understand the word facilitates in here. I think that's an error. Let's read it as I think it's meant to be. Which of the following forms of data visualization is least likely to be used for time series analysis? Well, it is pie chart, because pie chart doesn't show things over time. It shows a snapshot at a particular point in time, whereas a line chart can show time. A scatter diagram can show time. A bar chart could. It's not the ideal one. Okay, I'll end this video here. That's all of section A covered. As I said before, section B and C are done in separate videos. Thanks for listening.